Good day. We are the Group 1, and we will present to you and report to you about the revenue from contract with customers. So we will proceed on the old standard IAS 18 revenue, outlines the accounting requirements for when to recognize revenue from the sale of goods, rendering of services, and for interest, royalties, and dividend. So in a sense, where IAS 18 addresses when to recognize and how to measure revenue. Revenue ay yung gross inflow of economic benefits during the period arising from the ordinary course of activities ng isang entity kapag yung mga inflows or mga inflows ay magre-resulta sa pagtaas o pag-increase ng equity other than increases relating to the contribution from equity. So timing of revenue recognition under IAS 18, sale of goods. So first, magkaka-recognize ka ng revenue under sale of goods. And first, transfer of risk and rewards. Siyempre, yung sale of goods is mata-transfer ng risk and rewards sa kanyang customers. Second, it retains neither continuing managerial involvement nor effective control over the goods sold. Third, revenue can be measured reliably. Siyempre, for the sale of goods, makaka-recognize ka talaga ng revenue along with to the seller. And those revenue can be measured reliably. Fourth, it's probable that the economic benefits associated with the transaction will flow to the seller. So it is probable or it could happen or mangyayari talaga na may transaction na pagbebenta ng goods sa iyong customer, and it will flow directly to your seller or your customer. Fifth, cost incurred or to be incurred in respect of the transaction can be measured reliably. So yung mga cost na na-incurred or mai-incurred pa lang can be measured reliably. Rendering of services. First, it can be measured reliably. So, syempre, kapag na-render mo na yung mga services sa iyong customer, may matatanggap kang revenue agad-agad. And it can be measured reliably. Two, probable that the economic benefits will flow to the seller. Third, stage of completion at the balance sheet date can be measured reliably. So, syempre, kapag na-render mo na yung services mo, ibig sabihin na kumpleto mo na yung mga services to your customer. Fourth, cost incurred or to be incurred in respect of the transaction can be measured reliably. So, in revenue recognition under sale of goods and rendering of services, pareho lang sila. Next will be the effect of time value of money on revenue under IAS 18. The imputed rate of interest is the more clearly determinable of either first, the prevailing rate for a similar instrument of an issuer with a similar credit rating, or if hindi available, we have the rate of interest that discounts the nominal amount of the instrument to the current cash sales price of the goods or services. The difference between the fair value and the nominal amount of the consideration is recognized as interest revenue in accordance with paragraphs 29 and 30 and in accordance with IFRS 19. So, yung difference ng fair value at yung nominal amount will be recognized as interest revenue. So, that will be all for my report. Thank you.
Good day everyone, I am by Alea E. Amirol. I'm going to discuss the IAS 15. So the objective of IFRS or IAS 15 is to establish the principles that an entity shall apply to report useful information to users of financial statements about the nature, amount, timing, and uncertainty of the revenue and cash flow arising from a contract with customers. So this covers the revenue impacted, timing of revenue recognition, effect of time value of money on revenue, and accounting for warranties. So this is under the new standard. Revenue impacted. IFRS 15 specify how and when an IFRS reporter will recognize revenue as well as requiring such entities to provide users of financial statements with more informative, relevant disclosures. The standard provide a single principle based on 5-step model to be applied to all contracts with customers. An entity recognizes revenue in accordance with the core principle by applying the following steps. Step 1. Identify the contract with the customer. A contract with a customer will be within the scope of IFRS 15 if all the criteria are met. The contract first is the contract has been approved by the parties to the contract, and each party's rights in relation to the goods or services to be transferred can be identified. The payment terms for the goods or services to be transferred can be identified, and the contract has commercial substance. And also, it is probable that the consideration to which the entity is entitled to in exchange for the goods or services will be collected. If a contract with a customer does not meet all the criteria, the entity will continue to reassess the contract going forward to determine whether it subsequently meet the criteria. So from that point, the entity will apply the IFRS 15 to the contract. So step 2, identify the performance obligation in the contract. At the inception of the contract, the entity should assess the goods or services that has been promised to the customers and identify as performance obligation. A goods or services that is distinct or a series of distinct goods or services that are substantially the same and that have the same pattern of the transfer to the customer. So a series of distinct goods or services is transferred. The customer is in the same pattern if both following criteria are met. So each distinct goods or services in the series that an entity promises to transfer consecutively to the customer will be performance obligation that is satisfied over time. And a single method of measuring progress will be used to measure the entity's progress toward complete satisfaction of the performance obligation to transfer each distinct goods or services in the series to the customers. A goods or services is distinct if both of the criteria are met. The customer can benefit from the goods or services on its own or in conjunction with the readily available resources, and the entity's promise to transfer the goods or services to the customer is separately identifiable from other promises in the contract. So step 3, Determine the transaction price. The transaction price is the amount to which an entity expects to be entitled in exchange for the transfer of goods and services. When making this determination, an entity will consider past customary business practices, where a contract contains elements of variable consideration, and the entity will estimate the amount of variable consideration to which it will be entitled under the contract. So, variable consideration can arise, for example, as a result of discount, rebates, refunds, credits, incentives, performance bonuses, penalties, or other similar items. So, variable consideration is also present if an entity's right to consideration is contingent on the occurrence of future event. So, step 4, allocate the transaction price to the performance obligation in the contracts. So, where a contract has multiple performance obligation, an entity will allocate the transaction price to the performance obligation in the contract by reference to their relative standalone selling prices. So, if a standalone selling prices is not directly observable, the entity will need to estimate it. So IFRS 15 suggests that various methods that may be used, including the adjusted market assessment approach, expected cost plus a margin approach, and residual approach only permissible in limited circumstances. So any overall discount compared to the aggregate of standalone selling prices is allocated between the performance obligation on a relative standalone selling price basis. So in certain circumstances, it may be appropriate to allocate such a discount to some but not all the performance obligation. And last one is the step 5. Step 5, recognize revenue when or as the entity satisfy a performance obligation. So, revenue is recognized as control is passed, either over time or at a point in time. So, control of an asset is defined as the ability to direct the use of and obtain substantially all the remaining benefits for the asset. So, this includes the ability to prevent others from directing the use of and obtaining the benefits from the asset. The benefit related to the asset are the potential cash flow that may be obtained directly or indirectly. So, this includes but not limited to IFRS 15 31-33, using the asset to produce the goods or provide services, using the asset to enhance the value of other asset, using the asset to settle liabilities or to reduce expenses, or selling or exchanging the asset, or and pledging the asset to secure a loan and holding the asset. So, an entity recognizes revenue over time if one of the criteria is met. So, the customer simultaneously receives and consumes all the benefits provided by the entity as the entity performs the entity performance create or enhance an asset that the customer control or as the asset is created, or the entity performance does not create an asset which an alternative use to the entity, and the entity has enforceable right to payment of performance complete to date. If an entity does not satisfy its performance obligation over time, it satisfy it at a point in time. So revenue will therefore be recognized when control is passed at the certain point in time. Factors that may indicate the point in time at which control process includes but not limited to the entity has a present right to payment for the asset, the customer has legal title to the asset, the entity has transferred physical possession of the asset, the customer has legal title to the asset, and the entity has transferred the customer has a significant risk and reward related to the ownership of the asset, and the customer has accepted the asset. So, timing of revenue recognition. So, an entity recognizes revenue by applying the 5 steps processes as indicated in the previous slides. So, under the step 1, one of the criteria is to be met is that parties to the contract has approved the contract in writing or orally or in accordance with the customary business practices and are committed to perform in their respective obligations. So this condition are when or is when no remaining obligation are to be performed or contract has been terminated and consideration received is non-refundable. So, an entity transfer control of goods or services over time. Sabi ko na ito kanina, and therefore, satisfy a performance obligation and recognize revenue over time if the following criteria is met. So, the customer has simultaneously received and consumes the benefit provided by the entity, provided as the entity performs. The entity performance create enhances an asset, that the customer control has an asset is created or enhanced, or the entity's performance does not create an asset with an alternative use to the entity, and the entity has enforceable right to the payment of performance complete to date. So, how to identify and allocate the different goods and services within the contract? First is the entity does not provide the significant services of integrating the goods or services with other goods or services promised to the contract into a bundle of goods or services that presents a combined output for the customer has contracted. Letter B, the goods or services that not significantly modify or customize another goods or services promised in the contract, and the goods or services is not highly depend on the highly interrelated with other goods or services promised in the contract. Next is the effect of time value on revenue. So, under IFRS 15, revenue from contract with customers, in determining the transaction price, an entity shall adjust the promised amount of consideration for the effect of time value of money in the timing of payments agreed by the parties to the contract. So, it's either explicitly or implicitly. So, it's provide the customers or the entity with a significant benefit of financing the transfer of goods or services to the customers. So, in those circumstances, the contract contains significant financing components. So, lastly, the accounting for warranties. So, this is under the IFRS 15, revenue from contracts with customers. IFRS 15, B28-B33. So, accounting for warranties. So, this is a type of accounting that companies use to allocate expenses for replacing or repairing damaged products for customers. So, if a company establishes a warranty policy, it can estimate the amount in product warranty claims it anticipate to expense under the policy. So, during the accounting period, the company accrues expenses that reflects the cost for fulfilling the product warranty claims. So, if a customer has an option to purchase a warranty separately, for example, because the warranty is priced or negotiated separately, the warranty is a distinct service because the entity promises to provide the service to the customer in addition to the product that has functionality described in the contract. So, when accounting for warranties expense, companies estimate the amount at the time of product to ensure the most accurate cost projection for repairing or replacing the defective items. So if a customer doesn't have the option to purchase warranty separately, an entity shall account for the warranty in accordance with IAS 37 provisions, contingent liabilities, and contingent asset unless the promised warranty or a part of the promised warranty provides the customer with a service in addition to the assurance that the product complies with agreed upon specifications. So this is under the IFRS 15 B30. So that ends my report. Thank you, ma'am.
Let's proceed to the next topic, which is construction contract. First, what is construction contract? So it is a contract specifically negotiated for the construction of an asset or a combination of assets that are closely interrelated or interdependent in terms of their design, technology, and function, or their ultimate purpose or use. Construction contracts include contracts for the rendering of services that are directly related to the construction of an asset, and contracts for the destruction or restoration of assets and the restoration of the environment following the demolition of assets. So, construction contracts are generally long-term. The date at which the contract is entered into the date the contract is completed normally fall on different financial reporting periods. The primary issue in the accounting for construction contracts is the timing of recognition of contract revenue and contract costs. A construction contract may be either fixed price contract or cost plus contract. Fixed price contract, from the word itself fixed, it is when the contractor agrees to a fixed contract price or a fixed rate per unit of output. For example, A contracted Mr. Architect Engineer Contractor to build a house. The contract states a price of 6 million for the house. Therefore, the contract is a fixed price contract and the transaction price is 6 million. Next is the cost plus contract, in which the contractor is reimbursed for allowable or defined cost plus a fee. The two types of cost plus contract are: first, cost plus variable fee contract, in which the contractor is reimbursed for the cost plus a percentage of those costs. For example, the contract states that A shall reimburse Mr. Contractor the total construction cost plus 15% thereof. Therefore, the contract is a cost plus variable fee contract, and the transaction price is equal to the reimbursable cost plus 15%. Next one is the cost plus fixed fee contract, in which the contractor is reimbursed for the cost plus a fixed amount. For example, the contract states that A shall reimburse Mr. Contractor the total construction cost plus 2 million pesos. Therefore, the contract is a cost plus a fixed fee contract, and the transaction price is equal to the reimbursable cost plus 2 million pesos. Next is the computation and recognition of construction revenue. First is the percentage of completion method. This method is to be used when the outcome of the construction contract can be estimated reliably. It is determined as the ratio of total cost incurred to date over the estimated total contract cost. Total cost incurred to date represents the cumulative cost incurred from contract inception up to the current reporting date. Estimated total contract cost pertains to the forecasted total cost of completing the contract. This can also be determined to the sum of total cost incurred to date and estimated cost to complete. Estimated cost to complete pertain to the anticipated additional costs required to fully complete the contract. Another way of computing the percentage of completion is total cost incurred to date divided by total cost incurred to date plus the estimated cost to complete. For example, in 2021, ABC Construction enters into a contract to construct a building for a customer. The contract price of 6 million will be billed to the customer periodically based on ABC's progress on the construction. Case number 1, estimated total contract cost. The estimated total contract costs are 4 million and the total costs incurred in 2021 are 1.2 million. Requirement number 1, how much revenue is recognized in 2021? First, let's compute the percentage of completion. Total cost incurred to date divided by estimated total contract cost. So 1.2 million divided by 4 million is equal to 30%. So the 30% is our percentage of completion. So revenue in 2021 is computed by contract price times percentage of completion. So the contract price is 6 million multiplied to the percentage of completion, which is 30%. So the revenue in 2021 is 1,800,000. And lastly, the zero profit method. This method described as POC based on a zero profit margin. The revenue in this method is recognized in an amount exactly to cost incurred until reasonable objective estimates of POC are available.
Good day, everyone. I am Juleni Ala, and I'll discuss the concepts of the installment sales method. So first, ano nga ba yung installment sales? Yung tinatawag na installment sales. So it is a form of revenue recognition where revenue and expenses are recognized at the time of cash exchange. So the installment sales requires the buyer to make regular payments, which is ito na yung tinatawag nating installments. So let's say, bumili si buyer ng laptop, which is payable for, let's say, 24 months. Kasi yun yung nasa laman ng contract. So, kailangan magbayad ni buyer ng installments for 24 months. So, under the installment sales, we have this what we call installment sales method, which is yung method na to is not in accordance with PFRS 15. So this method will be used for taxation purposes or when the entity is a micro entity, kung saan yung micro entity na yun ay gumagamit ng income tax basis of accounting. So, konting discussion lang kung ano yung kinaibahan ng regular sales sa installment sales. So, sa regular sales, ang entry natin for the date of sale would be debit accounts receivable. We credit naman yung sales. And we debit cost of goods sold. We credit inventory. And kapag naman makakatanggap na tayo ng installments, I mean ng payment or ng collection, ang entry would be debit cash, credit accounts receivable. Kung saan yung date of collection na yun is one time lamang or isang bayad lang. Unlike sa installment sales na mayroong series of collection, meaning hindi lang isahan yung bayad, kundi maraming yun na, series of payments. So, ang mangyayari doon, sa date of sale, ang magiging entry natin would be debit, installment, accounts receivables, and credit sales. Then, we debit naman cost of goods sold and credit inventory. So, sa year-end, ang magiging entry natin would be cost of goods sold debit, and we credit inventory and deferred gross profit. Meanwhile, sa entry naman ng date of collection, ang magiging entry would be debit, cash, credit, installment accounts receivable. So this method originated from the traditional US GAAP and was applied typically by entities providing financing through long-term installment sales. So, as what I have said kanina, installment sales requires series of payments over a period of time. So next, as the installment sales or installment may have an advantage for buyers, this, on the other hand, exposes the seller to a greater risk of non-collection. Why? May expose si seller sa risk of non-collection dahil nga maaring hindi magbayad si buyer or maaring maging insolvency buyer, and hindi na niya mababayaran yung remaining payable since nga mas mahaba nga yung period of contract. So, next naman, yung losses from the installment sales ay mas greater sa losses na nag-a-arise from short-term credit sales. So next, under this method of accounting, the recognition of gross profit is deferred until cash is collected. So each cash collection on a contract is regarded as including both a return of cost and a realization of gross profit in their ratio to the selling price. Next, we have the general approaches used in recognition of gross profit in installment sales. So first approach, we have the gross profit is recognized at the time of sale. Next approach is yung gross profit naman is nire-recognize in installments over the period of the contract on the basis of cash collection. So next slide, we have the methods of recognition. So we have three: the cost recovery method, second, the gross profit realization, and third, the installment method, which is yung dinidiscuss ko nga. So first, yung cost recovery method. In this method, collections are first treated as cost recovery. Nare-recognize naman ang profit once collections exceeded the cost. And yung collection na yun, regardless of whether it's principal or interest, will be part of cost. So this method is too conservative but best for mga products na hindi nag-aalaw ng repossession. So second, we have the gross profit realization. So collections are first treated as realization of gross profit. So recap lang, yung difference nila sa una is that sa cost recovery, yung collections tinitreat muna as cost recovery. Sa gross profit realization naman, yung collections ay tinitreat muna as gross profit. So this method lacks conservatism. So third, we have the installment method. So the installment method, yung collections naman ay hindi tinitreat first as cost recovery at hindi tinitreat first as gross profit, kundi yung collections tinitreat as partly cost and partly realization of gross profit in proportion to their rates upon sale. So this method is frequently used in practice and is acceptable for income tax purposes. So if silent, we choose the installment method because the collectivity of the note is not reasonably assured. So lahat naman is prescribed by the standards. Pero if silent, yung installment sales yung gagamitin. So that's it for the installment sales method. Next, we have the franchise method.
So good day, ma'am. Good day, classmates. I am Mary Benedict Tiabagan, and I'm going to discuss the franchise under IFRS 15, revenue from contracts with customers. So, in IFRS 15, there's a section called like 13. Licensing provides a specific principle that do relate directly to the accounting for franchise sales. So, in IFRS 15, a license defines as the one that establishes a customer rights to the intellectual property of an entity. Since franchises is considered as an intellectual property, it is under the licensing. So by its definition, franchise is a business model in which one party, known as the franchisor, grants another party, known as the franchisee, the right to use its brand name, trademarks, operating systems, and other proprietary knowledge and resources to operate a business. So, you see, a franchise is an contractual agreement or arrangement under which the franchisor grants the franchisee the right to sell a certain products or services or to use a certain trademarks that is usually within a designated geographical area. So, the example of franchises here in the Philippines are the Jollibee fast food restaurant and the 7-Eleven convenience store, and FM radio station, and other more. So, as to purpose. So, franchises do allows a business to expand its brand and to reach more customers while minimizing the risk and investment. So, by granting a franchise to a third party, the franchisor can leverage the franchise agreement, investment, and local knowledge to establish a new outlets in different geographic regions. So, in IFRS 15, these standards to provide the guidance on the recognition and measurement of revenue from franchise agreements. So it requires the franchisors to recognize revenue when the franchisors has fulfilled all of its obligations under the franchise agreement, and the franchisee has gained the right to operate the franchise. So the revenue recognition in here is that the revenue from a franchise agreement is recognized when the franchisor has fulfilled all of its obligations under the franchise agreement, and the franchisee has gained control of the right to operate the franchise. So this means that the franchisor must have transferred the right to use the intellectual property and other resources to the franchisee, and the franchisee must have the ability to direct the use of those resources to generate economic benefits. So we do have an illustrative problem here that yes. So this so we do have an illustrative problem here. So on January 5, 2016, McDonald's or McDo Incorporated granted franchise to Mr. A. De Jesus to sell McDo products. So the initial franchise fee is 10 million pesos. Then on February to November the same year, the McDo Incorporated rendered the following initial services under the franchise contract. So we do have here the direct cost of the initial services worth 2 million pesos, and the indirect cost of services worth 50,000 pesos. Then on December 1, 2016, the franchisee, Mr. A. De Jesus, started operating its business. So in case 1, we have here only the initial franchise is paid in full when the agreement is signed on July 2, 2016. So the following entries will be made the franchisor during the year. So to record the receipt of the IFF, first we're going to debit cash 10 million, and we're going to credit the deferred revenue from the IFF 10 million also. Then next is from the month of February to November. To record the payment of the franchise cost, first we're going to defer the cost of franchise revenue for 2 million and the franchise expenses for 50 million. Then we're going to credit the cash of 2,050,000. This is to record the payment of the franchise cost. Then on December 31, the adjusted entries. So to record to adjust the cost of the franchise revenue, first we're going to debit the cost of the franchise revenue for 2 million pesos and credit the deferred cost of the franchise revenue worth also as 2 million pesos. Then to recognize fully as a revenue the initial franchise fee, first we're going to debit the deferred revenue from the IFF that is worth 10 million pesos and credit the revenue from the IFF also as 10,000 pesos. So that's for my part. Once again, I am Mary Benedict Tiawagan, and thank you.